Hello everyone, welcome to chapter 12. This chapter is going to be all about the open high low close or the open low high close concept. Now this is one of the most underrated concepts when it comes to ICT or CRT trading, but I almost use it every single time when I'm doing my pre-session analysis or when I'm trading, right? In this chapter we're going to break down everything about the open high low close concept, and we're going to discuss how you can use it to assist you in your trading and your analysis. After watching this chapter, you're going to be fully equipped about its details and intricacies, and you won't need anything else apart from it about this particular concept. We're going to discuss what it is and how you're going to be using it in your analysis to assist you. Alright, let's move on to the next slide and let's discuss what open high low close is. So, as most of all already knows, it basically stands for open high low and close in case of OHLC, and similarly in case of OLHC or a bullish candle, it stands for open low high and close, right? This concept is a bit familiar to market profiles, intraday profiles, and weekly profiles, and has certain characteristics similar to those concepts, right? Because they've got the same underlying core concept, right? The core concept for all of them is the same, right? Just like with intraday profiles, we use them to break down a daily candle into different segments. And the same way, we're going to use open high low close or open low high close to break down candles on any single time frame, right? In the same manner, with a lot more details, which will have its own opening and closing times as well, right? We're going to discuss this all. Similarly, you might remember that market profile. With market profile, we built our fundamental understanding around how price generally moves, right? And we use it all the time in our analysis, right? But we know that market profiles lacks framework in terms of providing time aspects or price ranges, right? That's why we make sure to always use market profiles in conjunction with key levels and dealing ranges so that it offers us a framework and we can work within that framework. Now, with the open high low close or open low high close, we're going to use the same market profiles on a micro level with its own logical framework, while at the same time combining with key levels or higher time frame key levels, right? So, in summary, open high low close is used to break down a single candle into multiple dynamic phases and sequences, right? And it can be done on any single asset or any single time frame, right? It doesn't matter because after all it's fractal. Now, the reason open high low close is more advanced than intraday or weekly profiles is due to the fact that not only it provides its own framework, but also it has opening and closing times to it, which gives it its own time aspect, right? Which makes it easier for us to gauge through and measure price, right? That's the most important thing about this concept. Now, with opening and closing times, it becomes easier for us to expect market profiles at the right place and at the right time, right? And we can easily gauge through and measure through price when we have those two aspects, the opening time and closing times. And we know for each and every single candle, we've got those two factors already, right? It's a fundamental part of a candle. So when we are breaking down a candle with open, high, low, close, it's a lot easier for us to break down the whole candle into multiple phases or sequences. We're going to discuss what are the different sequences in a minute, but let's discuss what open, high, low, close is in a more refined manner. Now, the most important thing about OHLC or open, high, low, close is that it helps in the development of our anticipatory skills, right? And what I mean by that is with the help of this concept, you're gonna finally have a filter which will help you stay in or stay out of the markets, right? Meaning it's gonna give you a filter with the help of which you're gonna be able to differentiate between high probability conditions or low probability condition, right? With this perspective, you're gonna be finally able to gauge between the two types of conditions, and you're gonna be able to make more refined and more conductive and critical decision whether you want to engage with the markets or whether you don't want to, right? And you're going to do that with the help of this concept. Now it will tell you, or basically you'll be able to tell whether you want to approach the markets at a specific time or at a specific price or not, right? Or you just want to stay risk off. You're going to be able to do that with this concept. Now, it will not only help you with the first few things that I mentioned, but this one too, which is kind of the most important in my opinion, right? It will help you build your anticipatory skills. That's one of the most important thing about this concept, and why I deem it as a significant concept, right? Because of this particular part. We're going to discuss this part even more in the last part of the chapter, but let's get over. Now, all of these chapters, just as I said before, are designed in a way so that I'm introducing you to each one of these concepts in a logical manner, right? And I'm making sure that you are being equipped with the right knowledge at the right time, right? I don't want to give you any concept or anything at the wrong time, right? Because that is going to cause either overwhelming or underwhelming for you. And I want to make sure that everything is balanced so that you're getting your knowledge at the right time, right? That's because it has to be balanced, right? You can't overdo it or underdo it, right? There's both of them are gonna cause um, troubles for you, but when you make sure that you are learning it properly, right, and you're getting all of this knowledge at the right time, with also being shown how you can use it in live markets through the help of these breakdowns, all of those things together will make sure that you are fairly being equipped with the right knowledge, right? So, and that's exactly my goal with CPI. Now, as I said before, every one of these new concepts are connected with the latter ones, right, that we discussed before in the latter chapters, and they'll all be used in conjunction with each other. It's the predominant theme of CPI. It has always been like this, and it will stay to be like this, right? So, open high low close is used as a framework for accurately and precisely understanding how market maker influences the ranges, expansions, or reversals in the market, right? And how do the market movement occurs and what factors influences them, right? And most importantly, how you can catch them, how you can exploit them. That's the most important part. Now, let's move on to the next slide and let's discuss some important things regarding open high low close or open low high close. The first important thing is that it will help us in building our price anticipatory skills, right? In the most refined way possible. We're going to discuss this later in the chapter. Second thing is that it will help us build a perspective that is predominantly based on liquidity. What I mean by that is that you'll dump the idea of pattern trading and you start looking at the markets with a logical perspective in terms of liquidity, right? You'll know how liquidity is generated, how it's purged, when it's purged, and most importantly, how you could exploit that perspective in your analysis, right? You're going to be able to do that with this concept. The three main aspects of this liquidity based perspective are knowing what engineering liquidity means, where does it happen, how does it happen, and exactly why does it happen, right? It could also be referred to as the accumulation of liquidity, right, or open interest. So you must know that what engineering liquidity means and how does it happen. The next thing that you need to know is that how liquidity is purged, right? What we mean by purging liquidity or manipulating liquidity, right? You need to know that as well. And the next one is the neutralizing of liquidity or liquidity being neutralized, right? Neutralizing of liquidity is done in two sequences, right? First of all, the purging and manipulating liquidity by taking it out, right? And then having a distribution or expansion in the opposite direction, and neutralizing and balancing out the liquidity by having a range expansion or by having a distribution, right, towards the drawn liquidity, towards the higher time frame drawn liquidity, right? So you need to remember that. The third one is order pairing, right? And this will help you understand why all of the above happens and what liquidity actually is, right? Order pairing will help you understand liquidity even more. Then last but not least, we're going to use all of these in conjunction with market profiles, key levels, dealing ranges, and so on, right? Moving on, right here you can see these two candles, right? These are the classic buy and the classic sell candles. Now, your job as a trader is to catch one of these candles either throughout the week or throughout the day, right? So if you're trading the weekly candle or you are a swing trader, right, then your job would be to catch at least one of these candles throughout the week on the daily time frame. And similarly, if you are an intraday trader, then your job would be to at least catch one of these classic buy or classic send candles on the 4-hour time frame. And obviously, you're going to trade that on the 15-minute time frame. Uh, these are the types of candles and the classic buy and sell candles where you're gonna find most of your trading opportunities and trading ideas, right? Because after all, your job is to catch expansions and stay out of the ranges or retracements. Now, before the candle forms, you won't know if it's gonna be a classic buy or sell candle, like, right? But there are certain factors which are gonna help you filter out market conditions and help you accurately catch expansion candle like these, right? We're going to discuss this in this chapter. Now, we all know how a candle works and how does it form, right? First, we've got the open of the candle, where the candle opens at a specific time of the day at a definite time. And then after that, either we form a high or a low, and then after that we expand towards the opposite direction, in which we form the opposing high or low, right? And then it closes at a definite and specific time. That's what a candle is, right? That's basically how a candle forms in a nutshell. We all know that, right? But what makes this concept so interesting and helpful is the fact that you can use these simple details to integrate market profiles and key levels with it, and those concepts together will help you determine and predict where the high and the low of the candle will be formed, and where the candle is gonna close, and where could it potentially be headed to, right? That's what trading is about. Knowing and anticipating where the next candle is gonna close and where can it expand to. And you're gonna be able to do that more accurately and precisely with the help of this concept. You'll be able to know at what time you're gonna take your entry, and at which times you're gonna stay out or stay risk off away from the charts. These simple details will give you filters and protocols for finding trader ideas or simply just staying risk off. Now, right here, just with these graphics, you can't really see the whole details and insight into this candle, right? But this single candle, when divided on the lower time frame, has multiple sequences and phases, which leads to the formation of this single candle as a whole on the higher time frame. Now, of course, you're going to be trading this on the lower time frame, so your objective would be to accurately predict and anticipate the open high low close sequences of a higher time frame candle, and then trade it on its respective lower time frame based on time frame alignment and time frame selection, right? That's up to you. This is how they work in a nutshell, right? Now let's move on to the next slide to discuss each one of these candles in great detail. So right here you can see that we've got this classic buy candle, or this classic buy side expansion candle, right? Now it looks sweet and cherries in hindsight, but we're gonna discuss it different intricacies and phases, and we're gonna discuss how it actually forms and how does it forms, right? We're gonna discuss each of those sequences or phases. So we all know that each candle has a specific, definite, and constant opening time, right? That opening time cannot be changed, and it stays constant all the time, right? Now before we move further, you must remember that you're going to make sure to combine and integrate this particular concept with the other concepts like the dealing ranges and key levels, and only then you're going to have to deal with this, and you're going to be able to integrate and incorporate and apply this concept accurately, right? If you're just going to use it alone, then obviously it won't help, right? All of these concepts have to be used in a logical framework, and only then you're going to have a higher precision and accuracy, right? So let's say you've determined that your higher time frame down liquidity is higher, and you've got a key level right here, right below you, and price has opened right here. We've got a key level below us, and the down liquidity is higher. You've determined that on the higher time frame with the help of all of those other concepts, and you've determined the down liquidity is higher. Now with the help of this concept, we're gonna divide the whole candle into multiple segments, and we're gonna see how we could have exploited this candle right here on the lower time frame, right? That's what your background base and framework is going to be. Down liquidity is higher, and we've got a key level below us, below the opening of the candle, right? As I said before, you're going to make sure that you already have the whole framework for the higher time frame down liquidity and buys before you analyze the charts with this concept, the open high low close or the open low high close concept, right? So coming back to the main topic, right here you can see that the candle has opened right here, and let's say the candle hasn't done any of this, right? It's just opened, right? It opened just now right here, and we've got a key level below us, right? And the down liquidity is higher. Then based off of these factors, what is going to happen is that more often than not, what is going to happen is that first of all, price is going to form a ranging profile or a range just above the key level at around the opening price, and it's going to do that for one thing, that is to generate liquidity or to accumulate liquidity or to accumulate open interest, right? The market moves either to generate liquidity, to take out liquidity, or to neutralize liquidity. These are the only things that the market moves for. If there's no liquidity, then the market won't move. The market moves from one place to another because it either wants to go and hunt or purchase liquidity or to manipulate liquidity, or either it expands and distributes to neutralize liquidity, or it forms a range to generate or accumulate liquidity, right? These are the three main aspects of every single market, right? Every single financial market. So whenever a candle opens, it always starts off with generating liquidity or accumulating liquidity, and that's always the first thing price does, right? That's why every time when you see that a candle opens or the market opens on Monday or any other single candle opens, more often than not, you're going to see that it forms a range there, right? It forms a range there, and it immediately goes into a ranging profile, right? And for the first half of the day or the first quarter of the day, it literally ranges, right? And it does that to, first of all, to generate liquidity or to generate open interest, right? Similarly, when the month starts or the monthly candle opens, it spends like the first week to basically generate liquidity for the rest of the month for monthly expansion or monthly range expansion. Similarly, we know that when a 4-hour candle opens, the first hour is more often than not spent on generating liquidity in the form of forming a range, right? And it usually ranges at the opening time. That's what you need to remember. So when you know this and you're aware of it, then you're always going to be cautious around the opening time, and right, and you're going to make sure to stay away from the charts at that time, because you know that price is more likely is going to form a range, and your objective is to only catch expansion, right, and stay away from ranges. So you're going to use that factor and use that fact as a filter to differentiate between lower probability conditions and higher probability conditions, and you know that a ranging profile or a range is a lower probability condition for you, so you're going to stay away from the charts at the uh, at the start of the opening time or whenever liquidity is being generated, right, above a key level or below a key level, right? And that is the exact reason why we usually skip Monday, because we know that it's highly likely that price could range for the first day to generate liquidity, so it's better to just stay risk off and stay away from the charts instead of messing with the markets, right? And then we trade that Monday's range the rest of the week, and we use that Monday's range to have range expansions or to distribute higher or lower. Now, obviously you have to remember that this isn't what happens all the time, right? There's going to be certain times where price expands right away, but that happens like really rarely and only in rare cases, right? So you also must be cautious about that as well, and I'm going to taught you that as well, right? How you can catch those sorts of expansions, and I'm going to also tell you why exactly that happens, right? We're going to discuss that. But what you need to remember is that most of the time, or more often than not, price forms a range to generate liquidity at the start of the opening of the candle or right around the opening time, opening price, right? Now, when we've generated enough liquidity for the market makers and it's ready to expand or distribute, first of all, it has to purge the liquidity, right? or simply take out or manipulate the liquidity. And with that, it's going to do two things. First of all, during the manipulation profile, it's going to test the higher time frame key level, and second, it's going to rebalance a dealing range, right, or an expansion swing or a higher time frame. These are the two things that it will do after liquidity is generated and then it's purged, right? Whenever we have a manipulation profile, that manipulation profile does two things. It first of all purges the liquidity that we generated earlier, and second of all, it rebalances a dealing range or an expansion swing on the higher time frame, right? Whenever you see a manipulation profile and you backtest those things, you're gonna see that it always do these two things, right? So you can note these two things down. With this purging or manipulation of liquidity, price forms the low of the candle or the high of the candle by testing the higher time frame key level and rebalancing the range. In this case, we've got a classic buy candle. So with this manipulation of liquidity, price forms the low of the candle by testing the higher time frame key level, which is below us, right? But now you can see that we've generated liquidity. First of all, we generated liquidity and now we've purged it, right? But now you can see that the liquidity has to now be neutralized because we are at a market imbalance. The liquidity is imbalanced, right? Because it was first generated and now it is being purged only on one side. So it is an imbalanced state of liquidity, right? And now it has to be neutralized and rebalanced. And that happens in the form of an expansion or distribution in the opposite direction, right? Or in the direction of the higher time frame drawn liquidity. For that neutralizing of liquidity, we expand toward the higher time frame drawn liquidity, and more often than not, we reach the opposing drawn liquidity or higher time frame key level close to the closing time of the candle, right? And with that, we finally form the high of the candle, and that results in the candle's range being capped, right? And then the candle closes, right? And that's basically the whole cycle of our candle forms, right? With that, we form the high of the candle and then we close the candle, and the close of the candle acts as a reset for resetting the whole cycle, and then a new cycle starts with the next candle repeating the same cycle over and over again, right? That's what happens every single candle, right? Generating liquidity, purging liquidity, and then neutralizing liquidity, right? And then last but not least, resetting the whole cycle by closing the candle, and then the same cycle repeats as soon as the next candle opens, right? That's basically how each candle is formed, and each candle works through the help of liquidity being generated, purged, or neutralized, right? This is basically how the market moves, and you should be aware of this. Now let's repeat it once again. Opening time acts as a generation of liquidity or forming a range. The low is formed after the manipulation into key level, and that is done to purge the liquidity which was generated earlier. After that liquidity is being purged and it's purged, we neutralize the liquidity by expanding above in the direction of the higher time frame drawn liquidity, and then price retrace close to the closing time, and then the closing time acts as a reset for the whole cycle to repeat itself, right? The closing time closes the candle and resets the whole cycle or the whole sequence. Now moving on, right here you can see that price opened right here and straight away it went into a ranging profile and formed this range just above the key level to generate liquidity. First of all, price generate liquidity or accumulated liquidity above the key level, and then the second sequence is where price purchased liquidity in the form of this manipulation profile, and with that it tested a higher time frame key level, and that resulted in the low of the candle being formed, right? That would give you enough confirmation that now the low of the candle has formed, and now liquidity could be neutralized and price can expand higher, right? This is the place when you would start looking for your entry setup on the lower time frame after liquidity is generated and the high time frame key level is tested, right? That is where you're going to start looking for an entry on the lower time frame, right? Your objective is to look for an entry right at this time. You're going to stay away from price during the range or ranging profile. After the manipulation profile ends, we can see that we formed the low of the candle and we've purged liquidity. Now the liquidity is at an imbalanced state, and now it has to be neutralized, and that occurs in the form of an expansion or distribution. In this case, we've got the higher time frame drawn liquidity above, so we're going to expand higher, right? And with that expansion, we neutralize liquidity until a higher time frame drawn liquidity or key level is reached. When a higher time frame drawn liquidity or key level is reached, the liquidity is finally neutralized, and now we can retrace a bit, and then the candle closes, right? Now the candle, the name candle is just a name for this whole sequence, right? This is basically a sequence of moves which happens in a dynamic fashion between two key times, right? For example, we are dealing with a 5 a.m. 4-hour candle, then we know that this candle forms from 5 a.m. till the end of at 8 a.m., right? We know that this is the time frame or the two timestamps within which a 4-hour 5 a.m. candle forms, right? This 4-hour candle starts at 5 a.m., which is its opening time, and then it closes right at 9 a.m., right? Which is its closing time, right? So basically, open, high, low, close shows us the sequence of the dynamic moves or phases which occurs during these 4 hours, right? And it tells us what actually happens during this time, right? It basically gives us a graphical overview representation of the whole sequences that occurs during this particular time, right? And obviously, we know that that's going to be dependent on what the higher time frame framework is saying based on daily ranges, market profiles, and key levels. Now remember that each time it will tell you a different story, and your job is to dissect and analyze what each candle is trying to tell you, right? And you're gonna tell that based off of combining it with higher time frame key levels and dealing ranges, right? And you're gonna see what has price done close to the opening time or close to the closing time, right? Those two things will uh, help you gauge price, right? Sometimes it's gonna form a candle with a huge wick, and when you use this exact framework, you're gonna know you're gonna be able to know that what had happened on the lower time frame, which led the markets to form this exact candle, this exact type of candle, right? Moving on, here we're gonna discuss a classic sell candle or a bearish expansion candle, right? It has got all the same details and intricacies as the classic buy candle with just a few differences, right? So right here again, you can see the opening price acts as a range to generate or accumulate liquidity below a key level, and then price manipulates above to purge the liquidity to test a higher time frame key level and form the high of the candle, right? And price then neutralizes the liquidity by expanding and distributing lower to reach the higher time frame drawn liquidity and test an opposing key level. And with that, it forms the low of the candle, and then it retraces above a bit, close to the closing time, and then the candle closes, which acts as a reset for the whole cycle. Now moving on, right here you can see that price right away started with a ranging profile from the opening time, and it generated liquidity below the key level. After that, we took out the range and the whole liquidity it generated, and we had a manipulation profile. After that manipulation profile, we have now imbalance in price, and price has finally formed the half the candle, and now we have to rebalance the liquidity and make sure that the market becomes rebalanced again. And for that, we know that it's going to get rebalanced by neutralizing liquidity, and which happens through an expansion or distribution of price lower, right? Which is also known as a range expansion lower. And then with that range expansion, we form the low of the candle, and the candle closes, resetting the whole cycle. Now we've discussed all of the intricacies and details regarding open, high, low, close, right? Now we're going to move on to the next part of the chapter, which will deal with how you can integrate these concepts this concept with the other ones and how we're going to use it logically in a proper framework, right? So moving on, in this slide we're going to discuss how we're going to accurately use open high low close or open low high close in a logical manner, right? Here are some important points you must remember. First of all, the open of the candle most of the time starts with a range. We've already discussed this before, but let me say it again. The open always and most of the time is a ranging profile which generates and accumulates liquidity, and for that reason you must stay away from charts at this particular time. Second point is that the high or the low of the candle which is formed during the manipulation profile or when liquidity is being purged, that high or low is always formed at a higher time frame key level, right? And that manipulation profile always happens to test a higher time frame key level, right? Next one is that the expansion occurs towards the higher time frame drawn liquidity or an opposing higher time frame key level. And as I said before, you're gonna make sure that you already have the higher time frame framework where you've already decided where the drawn liquidity is and what is your buy is going to be for the day or the week, and then based off of that you're gonna break down this whole candle that you're gonna be working with, right? And then last but not least, the close of the candle, just as I said before, acts as a reset for price to reset the whole cycle. These are some important points you must note, right? Now let's move over and let's see some examples of it. First of all, right here we've got a typical example of a classic buy candle or a classic expansion candle. You can see the lower time frame price action of this candle, and you can clearly see we almost immediately started off with a ranging profile, and for the first quarter of the candle it basically ranged without doing anything significant, right? So you would have stayed away from the charts at this time. That was the period of generating a generation of liquidity for this particular candle. Then you can see that price purged below the low, right? And the range it formed, price purged below it and had a small manipulation profile where it purged the liquidity it generated before. Now with this purge below the lows, there could have been a key level which price tested, right? And price formed the low there, right? And after that, price had to neutralize the liquidity, and which happened by price expanding above and distributing higher, with which price formed the high of the candle, right? Now remember, this candle could be on any single time frame, right? Literally it could be on the 1 minute candle, right? It could be a 1 minute candle, and still it'll follow the same rules and it'll have the same sequences, because we know that these concepts are fractal, right? So the time frame doesn't matter. You could replicate and use this sequence for any candle or any time frame and any asset, right? But if you want optimal performance, then you're going to use time frame selection and time frame element to determine your time frames and to use these concepts in the most logical and refined way possible. Second one we got right here is the classic down close candle or classic sell candle. And in this one again we've got the same framework. I started off with a range, then it purged the range and purged the liquidity by having the manipulation profile, and then it formed the high there, and then it expanded and distributed lower in a classic fashion, forming the low and then closing above to reset everything. Here we got another one. We're gonna combining it with the CRT, right? Now, as I said before, there always be a key level below or above these candles, right? So remember, when I'm showing you these examples, the low or the high is always formed at a higher time frame key level, right? So you must remember that. You must make sure that there is a higher time frame key level which can support price. You can see the first candle is a classic sell candle, right? And that sell candle is now going to be used as CRT, and you can see the next candle opened right away, taking out a CRT and testing a higher time frame key level, right? Right here you can see that this is a unique scenario because the candle right away tested a higher time frame key level, and did not generate any liquidity for the next one, but you can say it, you can see that it did purge liquidity below the other candle low or the CRT low, right? So now what price is going to do is to neutralize the liquidity by expanding above, because we produce an imbalance. We produce an imbalance by purging liquidity below the CRT low, and the CRT acted as a generation of liquidity, right? And then it purged it right away as soon as the next candle opened. And now the most likely scenario for price is to expand above and rebalance the range to form the high of the candle, right? And then as soon as the high is formed at a key level, price retraces a bit and it resets the whole cycle, closing the candle, right? These were some simple examples regarding open high low close or open low high close. Now we're going to move on to the most important part of this chapter, which is building and developing anticipatory skills, right? So this part of the chapter will deal with how you're going to use open high low close to refine and develop your anticipatory skills, and how you're going to make sure that you only trade the high probability conditions and avoid the lower probability ones, right? That's what anticipation is all about. Approaching price only when the time is right and when the price is right? And if neither of them or either one of them isn't right, then you're gonna sit out and wait. You're gonna stay risk off, right? That's going to be a definite protocol for you. We're gonna see how we're gonna combine this particular concept with key levels to accurately anticipate price action both on the higher time frame and lower time frame. We're gonna learn how to accurately and precisely integrate market profiles, right? We're going to see how it is used to probe order flow or measure order flow on the lower time frame. And then last but not least, it will be used as a filter for you. And I'm going to show you all of these, and I'm going to explain all of these to you on some charts example that I've prepared for you. So it's better for you to understand it properly, right? It's going to be better for you to understand it if I'm going to explain this on charts, right? So let's get into the examples. Right here you can see that we've got these price sections, right? On the left we've got the higher time frame price section, on which we'll discuss the open high low close, and we're gonna break down this candle. And to the right we have the lower time frame price section, and we're gonna see how both of them resonate with each other, and I'm gonna show you how they both relate to each other and how you could use open high low close to assist you in your analysis while combining it with higher time frame key levels. So in this example, I'll just use key levels to explain these, but you need to remember that you have to combine and integrate all of the other concepts too, and use them in your analysis as well, right? This will just build your fundamental understanding, so that's why I'm only using key levels, right? But you're gonna make sure that whenever you are doing your analysis, you have to integrate the other concepts as well, right? Just for the sake of the video, I'm only using key levels. So right here you can see that we've got this higher time frame price action, and you can see price opened right here, and till now it hasn't done anything yet, right? Now through my analysis, let's say I've determined that my run liquidity is this daily FEG's low. Now with that framework, let's see how I use open high low close to dissect and break down this particular candle on the higher time frame, and how can I make sure that I only enter in the high probability condition and avoid the lower ones, right? And how can I catch expansion with the help of this concept, right? You're gonna see that in just a minute. So first of all, is always priced after open, we're gonna expect price to generate liquidity in the form of a ranging profile or a range, right? That's what we're gonna expect. So let's see what happens. Right here you can see that first of all we formed a ranging profile and we generated liquidity there, right? And then after that generation of liquidity, we had a manipulation profile, and with that we took out the liquidity that we had generated and we purged it, right? You can see right here, this is where the liquidity was being generated in the form of this range being formed, and right here this is where it was purged, right? Now let's combine it with key levels and let's see what we've got. Now with key levels, you can see it becomes a lot cleaner. You can see that first we range below the key level, and then we manipulated above that range, and with that manipulation, just as I had mentioned it before multiple times, we tested a higher time frame key level in the form of this CRT high. And and with that we also successfully formed the high of this higher time frame candle. So now you can see we first generated liquidity, then we purged it, we formed the high, and now we know that our higher time frame liquidity is lower, and now the liquidity has to be neutralized, and we know that that's going to happen by price having an expansion or distributing lower, right? And with that distribution lower is going to form the low of the higher time frame candle, right? That's what's going to happen. So your job would be to enter right now and use an entry model to enter right here, and you're going to be able to successfully catch the expansions on the lower time frame. Now let's see what happens. You can see right here we neutralize the liquidity by distributing and expanding lower, and we rebalance the whole range with this range expansion, and we successfully found the low of the higher time frame candle, right, with this move, and we reached the higher time frame down liquidity. Now you can see we've successfully reached the higher time frame down liquidity. So now we're going to expect price to now retrace a bit till the closing times, and then the candle is going to close and it's going to have a reset. So moving on, right here you can see price retraced above because it reached the higher time frame down liquidity, and that acts as a support for price to close above, right? And price closed above and closed the candle and resetted the whole cycle. Now let's look at another example right here. Again, we've got these two price action. On the left is the higher time frame and lower time frame to the right. And now we're going to see how we could use open high low close or open low high close here to assist us in our analysis and helps us in building our anticipatory skills, right? And how we could anticipate the correct phases or sequence of price, right? And how we can use it as a filter to filter out lower probability conditions. So right here, first of all, as I said before, you're going to use all the different concepts to first of all determine your high time frame down liquidity, and only then you're going to use this particular concepts to assist you with probing the order flow on the lower time frame and breaking down the high time frame candle. So that through the help of all the high time frame analysis, I've determined the down liquidity is higher, and now we're going to use open high low close to help us probe the order flow on the lower time frame, and it's going to help us break down this higher time frame candle that we've got right here. Now let's see what happens at the opening time. First of all, you can see we straight away went into a ranging profile, and that's exactly we almost always do pretty much, right? And with this ranging profile, we successfully generated liquidity above the key level, and now we're going to see what key levels we've got on the higher time frame that we can match with the lower time frame price action, where price can successfully form the low of the higher time frame candle, and then we can expand above. Right here you can see that we've got this higher time frame key level in the form of this order block, right? So the framework is that first of all we generated liquidity from the opening price, and now we've got this higher time frame key level where price could have its manipulation profile to purge the liquidity and form the low of the candle, right? You're going to stay away from price throughout all this price action, and you're only going to approach it once price forms the low of the candle and once it tests the higher time frame key level, and then it shows you a change in the state of delivery, right? You're gonna only engage with price when that happens. Now let's see what happened next. Right here you can see we successfully tested the higher time frame key level by having this manipulation profile and purchasing the liquidity that we generated earlier. Now we can engage with price and approach it and potentially trade it on the lower time frame with our entry models or entry setups. Let's see what happens. You can see price neutralize the liquidity by distributing and expanding higher, and it rebalanced the range by having this range expansion, and then it closed, resetting the whole cycle. Here we got another example that we're going to use to see how open high low close could have helped us in our anticipation of price. First of all, let's see what happens and what sort of range price forms and where does it generate liquidity. Right here you can see that the first quarter of this candle price arranged and formed a ranging profile. Now let's combine key levels and let's see if we have any key levels where price can form its high of the candle and then potentially expand lower. Right here you can see that we've got this higher time frame key level in the form of this order block, and what price did is first of all it formed a range and generated liquidity, and then it purged above the range to test the higher time frame key level and purge the liquidity. Now, the only possible outcome for price is to neutralize liquidity by having a range expansion lower and the rebalance in a candle to form the low of the candle. Right? Let's see what it does. And there it is. Price expanded lower, forming its high, and here finally formed its low and closed, and then it closed the candle and resetted the whole cycle. Right? You can see more often than not, before closing, it always has a small retracement before it closes, right? And with that retracement, it forms the low of the wick of the candle. Moving on to the next slide, here are some important points regarding open, high, low, close that you must remember and note down. First one is an important one. Don't trade right away after the open of the candle, because we know that it always usually is a ranging profile, so it's better to not engage. Always wait for the high or the low of the candle to form at a higher time frame key level before trading it, right? This will ensure that you don't get caught up on the wrong side of the markets. When you only trade after the high or the low is formed, that will make sure you only take part in the expansion of the candle, and you can make sure that you catch the expansion, and you'll be able to easily and more accurately exploit it on the lower time frame. You would never want to take part while liquidity is being generated, because you would end up to be the liquidity yourself, right? And you wouldn't want that. Similarly, you would only take part during the manipulation or purging of the liquidity only if you are an advanced trader and you have a proper entry model for it, right? And you know the ins and outs of your model. Your job as a beginner or intermediate student should be to only take part when liquidity is being neutralized and if you're having an expansion or distribution. That will ensure that you catch the most explosive and expansive moves, right? Following the above two rules will make sure that you only catch high probability conditions, right? That's true. Always partial and get out completely as soon as an opposing key level is reached or the higher time does liquidity is met. That's pretty obvious and clear, right? So these were some points regarding open, high, low, close that you must remember when trading it or using it in your analysis, right?